Hi, I'm Max Keiser. This is the Keiser Report. Did you enjoy those summer solutions? Yeah, I know I did. Well, it's time to get back into the problems. So let's turn to Stacy.
Right. Well, the Fed had better hope the solution to inflation is just time, because remember, they keep on saying it is transitory. Well, their usual solution is giving more and more money. The Treasury is always giving more and more money, Congress more and more money. So we're going to look at what some of the results that have come out while we've been gone for the past 2 weeks. We've seen not only inflation numbers hit over 5%, the highest in a very long time since 2008, but container freight rate spike to new extremes, up 500% for Asia, US, Asia, EU since early 2020. And the worst is still ahead. And Wolf Richter uses a quote from Jerome Powell just under this. It turns out it's a heck of a lot easier to create demand than it is to bring supply up to snuff. So we'll go over some of the details on these rates, but they're pretty shocking, Max.
Right, yeah, that's a good comment by Wolf Richter about demand. It's always spoken about in Keynesian economics corners that they need to stimulate demand by printing money. But we live in an age now where the supply side of the equation is broken. So we're entering into these supply shocks, whether it could be microchips, for example, or basic commodities are up sharply. There's a food insecurity now by hundreds of millions of people around the world, just emerging over the past 12 months because of this runaway inflation, because of the runaway money printing, as we've been saying for a few years. So now people are really coming to grips with the fact that, yeah, Keiser Report's been right about it. What's next?
Right, so we'll go over some of the data. The important one to look at there in terms of the container freight rates is from Shanghai to Los Angeles. And so think about this. Everybody got a lot of stimulus checks. We covered this. Thousands and thousands of dollars over the past year, a year and 2 months. And what they did is they bought durable goods. They bought refrigerators, they bought washing machines. And where did it all come from? It came from China. So this is the most important one for this COVID lockdown story and the supply shortages and rates spiking. Average port-to-port spot rates from Shanghai to Los Angeles soared from around $1,500 per 40-foot container in early 2020, and from a 5-year average of $2,177 to $4,000 in September of 2020, to $8,000 in June of 2021, and $9,631 in the week ending July 8th, according to Drury Supply Chain Advisors. This would be an increase of over 500% from early 2020.
You see, there's two things that have been going on for the last 20 years. Number one, money printing. Number two, China enters global economy. And all that money printing went over to China along with American jobs, but the American consumer didn't notice that because the price of stuff coming in from China, like those white goods, the washers, the dryers, the TV screens, the clothes, was dropping precipitously, a lot cheaper. Well, at some point, as you pour water into a bucket, at some point the bucket is full and then the water starts to spill over. So here we have a situation where all the cheap gains that have accrued due to including China into the World Trade Organization under Bill Clinton have exhausted themselves. So all the money printing, like that water into the bucket, is now spilling over as real inflation. But I think the reason this has caught people off guard is that it took 20, 25 years to fill that bucket. Because bringing China on, as Bill Clinton did, was really a remarkable situation of putting 500 million workers making virtual slave labor into this globalized economy that was all hooked up through the internet. And we just had an amazing crash in the logistics prices and delivery prices. And remember, it was only 2 or 3 years ago, we were saying the price of these containers, the Baltic Dry Index, if you recall, on this very show, 2 years ago, 3 years ago, we would all say, oh my God, it's hitting new crash lows. It's so low, it's so low. But now it's all been essentially equalized or normalized. So the money printing is now going to hurt really badly.
The past 20 years, part of the reason why I didn't catch up was that there was a lot of money printing, but it was all credit. It came from the central bank cutting rates ever lower, taking these assets off the balance sheets of the banks and putting it onto the central bank's balance sheet. The past year, we've seen thousands and thousands of dollars sent to every single individual American. We saw those PPP forgivable loans, tens of billions of dollars given to small businesses. This is real money. It's filtered straight into the economy, and without a commensurate, of course, goods and services being provided here. So that's why you're starting to see the inflation, because everybody's spending it, but the only place to spend it is in China. And the volume is quite remarkable. So what you see is the Port of Los Angeles has been setting records in terms of the volume of imported loaded containers. The container volume is expressed in the standard measuring unit of TEU, which stands for 20-foot equivalent unit, where a 40-foot container contains 2 TEUs. For the 5 months from January through May, the port imported 2.37 million TEU in loaded containers, according to data from the Port of Los Angeles. This was up from 26% from the prior record period of January through May of 2017. So it set a new record high by 26% of the previous record high. You can see the parabolic move. It all started exactly, all of this data started exactly once the first stimulus checks started to pour into American coffers. So it is causing some inflation, is causing some friction as well, because of course you're starting to see headlines suggesting that it's China that's causing inflation, or you see signs that it's Bitcoin causing hyperinflation.
Right. Well, interesting. Those two being brought up in that context. Look, China's GDP is up like 18%, and the U.S. is barely positive. And why? Because China is trying to grow their economy. If you're trying to grow your economy based on manufacturing stuff and selling it, you're going to end up with people working, manufacturing stuff, and selling it. If you have an economy based on social justice warriors who are begging for more stimulus checks so they can give it all to China, your GDP is not going to go up because you're not manufacturing stuff to sell to Chinese people or anywhere else in the world.